Ladies and gentlemen, the stock market is falling again, and I would say it's in a very precarious situation. And we really want to watch the end of the day close because from a technical perspective, it will tell us a lot. If we flush into the close, yeah, that's looking nasty. If we rally into the end of the day, that looks much better. Now, prepare to be mind blown in this video because what if I told you investors are more bearish now than when the pandemic happened and during the 2022 bear market? Yeah, I know, it sounds crazy. This is the 7th most bearish reading of sentiment by investors in the history of the stock market. The AI Investor Sentiment Survey has went bonkers. People have lost their minds. 60.6% of investors are bearish right now. 20% flat or neutral, and 19.4% are bullish. This is unprecedented. Okay? Just completely unprecedented. If you thought this was a contrarian bullish indicator before, well, times that on steroids now. Take a look at this. This is the 7th highest spike in bearish sentiment ever, okay, with the S&P that's only down 3% from all-time highs. This is equivalent to the bottom of the 2022 bear market. You bottom 2 weeks later after this sentiment reading of 60.8% in 2022. This was September 29th, 2022. You are at a similar level of fear as the midpoint of the global crash, the global financial crisis, October 9th, 2008. This is a similar reading to the bottom of the 2022 bear market, again, where you bottom 3 weeks later. This was September 22nd. This was equivalent to the bottom of the 1990s bear market. Took place on August 30th, 1990, and you bottomed 1 month later. Bottom of the 1990s bear market, and the ultimate bottom of the 08-09 crash was March 5th, 2009, when you actually hit 70.27% of investors who are bearish. So normally when you're this bearish, you are like full blown in a crash. And well, we're not in a crash right now. Sentiment has completely cratered. Now, in other instances, this is a good buying opportunity or has been a good buying opportunity in prior, times where investors have been this bearish. And this is the mind-blowing part. Ryan Dietrich points this out on X. He says, in the history of the survey, since 1987, that has only happened 6 other times. The S&P 500 was an average of 27% off the highs, so firmly in a vicious bear. It was 3% off the highs this week. So normally when investors are this bearish, the S&P is down 27% from its highs. You're not even close to that, and sentiment is this bearish. Now, just to provide a little bit of further context on this, when more than 55% of AI Investor Sentiment Survey respondents are bearish, that tends to be bullish, especially if you remove 08 and 09. Many times we saw it trigger then, and stocks still crashed. But the majority of the other times, it was a fairly strong contrarian indicator. Is this another great financial crisis? That's the question. And again, you had a lot of triggers in there. If you strip out 08, 09, where there was a real problem, every other instance was a great buying opportunity, even in the short term. Like a lot of the time when this triggered, you were pretty close to the end of a bear market, like in 2022, and you were down substantially, and you recovered in the short term. Like, it didn't take years to recover after these, indicators were this bearish. Ryan Dietrich also shares this, which I think is very important to put into context, okay? He says that credit markets continue to show very little worry or concern. I trust those way more than a poll. He says investors might be more worried today than during a 100-year pandemic and bear market, but credit markets are telling us this is simply seasonal weakness and nothing more. You can see credit spreads of triple Bs, which are not necessarily junk, but not great by any means. Some people would say triple Bs are junk. You're just not worried. That's the bottom line. Like, you had a lot more worries even in July of 2024, right? I mean, you spiked a lot more then, and especially in 2023, than you are right now. And when you see credit spreads start to widen, that's when you should get a little bit more concerned about underlying weakness in the economy, because this is basically saying people that own like risky debt in companies are not concerned that those companies are going to go bankrupt. That's what this is saying, that they're not concerned of mass bankruptcies. You could read between the lines and say they're not concerned about recession. And I have a lot more to share with you guys in terms of broader sentiment and broader markets and data points throughout this video. But just to add to this, Renaissance Macro Research says this is the most bullish sentiment indication right now. In their opinion, high levels of policy uncertainty tend to be good for forward returns. We fade the fear. And you can see when you get these, green indications, it tends to be a really good buying opportunity. And you just got more of those, and you can see down here, you are in the top 90 percentile of, well, right here, U.S. economic policy uncertainty and news-based index. So you are very much in uncertain times. And when there's this much uncertainty, there tends to be a lot of fear, there tends to be a lot of selling pressure in stocks, and that tends to be a good buying opportunity. And what's really affecting markets today, including our favorite stocks, is two parts. First part, Nvidia. Second part, tariffs. The Nvidia part is pretty simple. Nvidia, they had an A+ quarter. There was nothing to really complain with there. Besides, margins came down a little bit more than expected, and that has some people nervous about what margins are going to look like throughout the rest of this year. Overall, A+ quarter. The typical Nvidia special, beat and raise. Really, Nvidia and Jensen Huang reinforced that AI is here to stay. There's essentially unlimited demand, and we don't have enough, chips, AI infrastructure built out to support the growth in AI. Like, there's going to be continuous build outs of this. Even Amazon's CEO said today, quote, "There's not enough chips and power to meet AI demand." So I don't really think there's an issue there. And I don't think the AI trade is collapsing by any means. Just think Nvidia earnings were kind of priced in. We didn't get any new information per se, just a validation of what we already thought. And that's causing some people to say, hey, well, is Nvidia a good risk to reward this year? I mean, there's a lot of other stocks that are beaten down that are probably going to also do well this year. And I think it's simply people taking chips off the table from Nvidia because there's other places to put money. Considering there's kind of a growth scare going on right now, people have been buying bonds. Like, is that a terrible place to be? Probably not. And I think that's all this is with Nvidia. But when Nvidia is down 3.5%, it does weigh down the index, and it does create algorithmic selling pressure. When Nvidia goes lower, basically all your other AI stocks also go lower, which is a good chunk of markets. But we did wake up to news today that Trump is announcing the tariffs on Canada and Mexico will now go into effect next Tuesday if, quote, the drug flow is not seriously limited. He also says that China will likewise be charged an additional 10% tariff on that date. Previously, we hadn't heard anything about an additional tariff on China. We kind of thought that was over with. And yesterday, we got news of a 25% tariff coming soon, probably as soon as April 2nd, on Europe or the EU. So you're just getting bad headline after bad headline, and that's the big driver, I think, today of the move lower in markets. China's Commerce Ministry says charging fees on Chinese ships entering U.S. ports would disrupt global supply chains, backfire on U.S. economy and employment. China warns that U.S. proposal to levy port fees on Chinese ships could backfire. We did also get January pending home sales, negative 5.2% month over month versus an estimate of negative 1.1%. So housing data just continues to be very weak. 3.1% negative was the prior month, and it was revised lower from negative 2.9%. So just bad news on top of bad news for the housing sector. And you're getting down to levels, pending home sales, we have not seen in, a long time. Minus the, Rona drop, you're getting back to levels like 2022 when people thought we were going into a recession. Now, also worth mentioning today is the CNN Fear and Greed Index is at 21. So you're still in extreme fear territory. Market momentum, extreme fear. Stock price strength, extreme fear. Stock price breadth is fear. Put and call options, extreme fear. Market volatility is neutral. Safe haven demand in extreme fear. And junk bond demand currently in fear. But what's actually interesting, though, about today, although you have the Russell 2000 down 0.6%, NASDAQ down about 0.6%, S&P's break even, the Dow is up 0.72%, but look at that, the VIX is down 2% today, even though it's a pretty rough day for your major indexes. Why is that? I think a lot of it has to do with Nvidia earnings. Nvidia not dropping the ball, alleviate some of the fears. I think investors probably bought some puts on the S&P just because of the risk that Nvidia said the wrong thing on the conference call, or the earnings were not, the typical beat and raise. I actually think the VIX falling today is a good sign. Now, the VIX is still sitting at almost 19. So again, just like every other metric right now, the VIX is showing a lot of fear. This morning, you also did get durable goods orders month over month that came in at positive 3.1%. Last month was revised higher from negative 2.2% to only now negative 1.8%. The estimate was positive 2% for durable goods. So those numbers, really good, alleviating some of the growth concerns, but offsetting that, you have a huge spike in initial jobless claims coming in at 242,000 versus estimates of 221,000, which you can see here, this is the highest weekly spike since Q4 2024. And it's actually interesting because in Q4 2024, with the big spikes, we kind of attributed that to weather events and, things that were outside of just natural control of the economy. This time around, not so much. The biggest weekly increases in initial claims by state has Michigan and Massachusetts and California in number 1, 2, and 3. Illinois, Ohio, Pennsylvania, Wisconsin, Iowa, Rhode Island, and what looks like Florida here, all in the top 10. The DC metro region didn't even make the top 10. So you can't just brush this off as Doge necessarily, or the, layoffs happening in the DC region. Like, this was more broader based. So given this data, I'm actually kind of surprised that 10-year treasury yields are up 4 basis points today to 4.29%. So you're actually seeing investors selling the bonds today, which, again, given the data, doesn't make a whole lot of sense, but is encouraging. It is encouraging from an equity perspective because when people go out and rush into bonds like they have been the last week or so, that's a warning sign for stocks. And you're not getting that same warning sign today. Again, mix that with the VIX that's actually down about 1.5%. It's really been down anywhere from 2 to 1% all day. Mix that together with high bearish sentiment and short term, that's a bullish indicator, in my opinion. Kansas City Fed President Jeff Schmidt says he is less optimistic about inflation than he was at the beginning of the year because of recent surveys showing consumers expect higher inflation. This is one thing that I was concerned with that seems to be confirmed. The Fed, I guess, is not smart enough to put 2 and 2 together and realize that the rise in inflation expectations via the Michigan Consumer Sentiment Survey was all political. It was Democrats that expect hyperinflation, Republicans expect no inflation, and independents expect 3% inflation. The Fed's taking these numbers at face value and making an issue of it. Putin announces that Russia and the US are ready to restore cooperation, and he says that not everyone likes the dialogue taking place, and countries and people are going to try to get in the middle of essentially stopping the war in Ukraine. And speaking at an AG conference, Kansas City Fed President Jeff Schmidt offers what he calls a radical suggestion to rethink excluding food from measures of core inflation, given how food prices have not been as volatile as energy prices. The White House has formally instructed agencies to prepare for large-scale layoffs. President Trump also directed that no later than March 13, 2025, agencies develop agency reorganization plans. And Fed Barkin says we must get used to higher mortgage rates like 2004 and 2005, which that's not happening. People with prices this high, that is just impossible, because you have to make 30% more than the average family to buy the average home in the US. Inevitably, prices will come down or rates will come down. We're just not going to get used to higher mortgage rates with home prices where they are. It's just mathematically impossible. Now, Seth Golden on X posted this. He says it's time to see just how closely SPX will follow the 2025 cycle composite. Today would start the uptrend through week 1 of March. So that's obviously not happening now, but this is basically taking every day of the markets from, I believe it's like 19, well, this one's a little bit different. This says cycle composite equals 1 year plus 4 year plus 10-year cycles. So basically just tracking what every day's return is over the course of the last essentially 10 years. And this is what 2025 should look like if it follows a historical average, which would be, markets up about 10.5%. And well, you're here now, which would mean you rise a little bit and then you come down. You ultimately bottom around the end of March and then you start to move higher. Now it says OPEC Plus is hesitant on going ahead with planned April oil output hike due to uncertainty over sanctions and tariffs, according to sources. Russia and the UAE would like to proceed with April oil output hike. Other members, including Saudi Arabia, favor a delay. Now, oil is up 2.22% today, and again, this is just another sign, along with 10-year treasury yields that are moving higher, that we're a little bit less concerned about a growth scare today. Oil has been plummeting recently because oil is one of those growth-sensitive commodities where if we go into a recession or something, oil falls. Or if we think we could go into a recession, people sell oil. So the fact that oil is rising today leaves, less uncertainty about the state of the economy. People are saying the economy is better than we thought yesterday. Although the data today really doesn't support that idea too much. Besides, of course, durable goods orders, which came in much better than expected. When you look at initial jobless claims or real estate data, though, it paints a much different picture. Technical look on the S&P, things look weird. I'm not even going to lie, because, you're sitting at your 100-day moving average. For the past 3 days, we've kind of traded between the 100-day moving average and the 50-day moving average. 50-day moving average here in purple has been resistance. 100-day moving average has been some support. Now, I think it's really going to depend how we close into the end of the day today. If we close near the lows of the day today and below that 100-day moving average, that is a really bad technical setup. Now, if we can move higher into the high of the day to close the day, that's going to be a really good technical setup, all things considered. So I think today into the close is really going to tell you a lot about what could be coming next short term for markets. Although keep in mind, when sentiment is this bearish, it doesn't take a whole lot to move markets higher because people are already so negative. If though we have a bad close today and the technical setup deteriorates, we could be setting ourselves up for a test of the 200-day moving average, which would be kind of unprecedented in recent history. I mean, really recent history. We haven't touched the 200-day moving average since October of 2023. That was the last time we hit the 200-day moving average. Most of the time in recent memory, you bounce around the 100-day moving average. So I think it is really important where we are in markets right now. Because if we don't bounce here, then you test that 200-day moving average. And from all-time highs to that 200-day moving average would be a decline of about 7.4%. 10% technical correction would put you down to about 552 on the SPY. So let me know what you guys think about all of this information down below in the comment section. Are you bullish? Are you bearish? Let me know your thoughts down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.